My name is Jake. Welcome to the channel. Today's video, I want to talk about why I sold QYLD and bought JEPQ. So if you watched my last video, I talked about the simple path to wealth with dividend investing. Now, the simple path with dividend investing is all about keeping it very simple, very straightforward, purchasing maybe one or two ETFs, and that's it. You buy as much as you can, as often as you can of SCHD and DGRO, and you hold them forever. Now, that's the simple path. If you want to go a step further and add a little bit more, nuance or complexity to your portfolio, that's what I do. So I invest into SCHD and DGRO as part of my core holdings in my portfolio, but I also hold, cover call ETFs that we'll talk about today, as well as individual companies that I hold in my portfolio. So just give you a really quick snapshot of my investing strategy or portfolio is I hold ETFs, like I talked about, with SHD and DGRO. I also own different individual companies. The individual companies that I own in my portfolio, they all serve a specific purpose of why they're in the portfolio, right? There's a reason why I hold utilities in the portfolio, as well as why I hold, companies like a Costco or a Union Pacific or, a Waste Management. They're growing a little bit differently. And so if you're new to dividend investing, or if you're new to my channel, some of this may not make a lot of sense. But if you watched a few of my videos here on the channel, you probably, understand the concept of why that is, why I have, different types of individual companies, because they serve one purpose, and that is to help my wife and I achieve financial independence so that we can retire early off of our dividend growth portfolio. So in today's video, I'm going to cover a couple of topics. First, I'm going to talk about why I sold QYLD and then bought JEPQ. I might say JEPE, or, it's just kind of out of habit. So I'm really actually talking about JEPQ. It doesn't roll off the tongue as nicely and smoothly as JEPE, JEPQ. I just sound, Anyways, we're going to talk about that. The second part of the video is I'm going to talk about what is JEPQ. I'm going to talk about, how they've compared, how QYLD and JEPQ have compared historically, though there's not a lot of data around that, but I'm going to show it anyways and kind of show you how they compare. And then lastly, towards the end of the video, I'm going to talk about who should not consider investing into a cover call ETF like JEPQ. So to start off, there's a handful of reasons why I decided to sell QYLD and buy JEPQ. And the first part of this is more personal to me. It's not really, something that would be applicable for everybody, but I wanted to share why I did it. Maybe there's people in my similar situation, maybe there's not. But there's some more fundamental reasons of why I did that would be more relevant for everyone across the board. So we're going to cover these 6 topics individually. So these cover call ETFs have gotten a lot of attention these last couple of years, especially during the pandemic. A lot of people, whether it be here on YouTube or on Seeking Alpha or other websites, a lot of people were talking very highly about QYLD. And I think 2020, 2021, QYLD was, at least from my experience, was the ETF that everybody was talking about. And then here this year in 2022, not a lot of people have been talking about QYLD. Now, there's a couple of reasons, and we'll touch on those here in the video. But, when I think about 2021 versus 2022, when looking at QYLD, it's looked a little like this.
All right? I hate people who are late.
Orale, vato. We're trying to see that product. Yo, Sleepy, what's up, homie? You know my cousin, Sad Boy.
I think you got the wrong guy, Holmes.
Man, you're Sleepy. Everyone's saying the body of Sleepy, he like the Mexican Wolverine. And my partner here, he want to see the product.
When he talking?
My name is Jeff.
Oh my gosh, I love that movie. I can't tell you enough. I've been cracking up the entire morning when making that clip. Oh my gosh, I love it. My wife has had to listen to me laugh all morning when creating that meme there. Anyways, I'm on Instagram. If you love dividend memes or investing memes, you can go and follow me there. I'll leave a link to my Instagram in the pinned comment below. right, so let me talk really briefly about the first reason why I sold QYLD, and that is because my time horizon is slightly shifted. So about 9 months ago or so, if you go to my channel, you go under videos, you can see that I made a video, we set our fire date. So about 9 months ago. So in this video, I talked about, our goals and our plans of retiring in 2024. And here earlier in the year, we actually had a rental property that we ended up selling. The tenant, ended the lease early. And I thought, well, we could maybe even retire in 2023. And then, with the market going the way that it is, we've decided to, keep our plans of 2024. And that's a big reason why, I've decided to transition out of QYLD, is my time horizon has changed slightly. And I really want a little bit more growth in the portfolio. And as these income ETFs, they're focused on income. And I still want a little bit more growth in the portfolio. So that's the first reason. The second reason is with tax loss harvesting. Now, this is very unique to me, right? So when I purchased QYLD, this was back in, I think, the end of March. And, it's down significantly from where I bought it, right? And so when I compare QYLD with JEPQ, they're very similar, right? They're not the exact same thing. But for me, I've had some gains in the portfolio, and I've decided, you know what? For me, I'm going to take advantage of tax loss harvesting, and I'm going to transition. I'm going to realize that loss in QYLD and transition into JEPQ. And that really, I'm not recommending that for everyone. You really have to look at your own personal situation. But for me, that's another reason why I decided to sell QYLD and transition into JEPQ. Another reason is the dividend itself. So with QYLD, every year has been a little bit different. Now on their website, they were a little bit misleading. You probably, if you're familiar with this ETF, you've probably heard people talking about that, where they were kind of misleading people on their website that it was going to be a return of capital. And at the end of the year, everybody was shocked and surprised that no, it was actually 100% qualified, non-qualified or ordinary income. And that's the least favorable, tax rate for investors, especially here in the United States. And so with JEPQ, it follows more of an approach like JEPB, where, percentage of it is going to be qualified and another percentage is going to be non-qualified. I think it's like anywhere from 15 to 20% will be qualified. And it's just, based off of the approach that the two ETFs take. And so that was another reason why I decided to transition out of QYLD into JEPQ. All right, the next reason that I wanted to switch these was the expense ratio. I mean, it's very, very straightforward. With QYLD, you have a much higher expense ratio than with JEPQ. And now you might be thinking to yourself, well, it's not that big of a difference. Well, let's take a look at some math here. And let me scroll in the screen here. You can see this. Let's take a look at the difference between a 0.6 and a 0.35 expense ratio. When you compare them, let's say, for example, if I were to invest $10,000 today and then $10,000 for the next, 30 years with an 8% compounding total return, average return, the difference is going to be about $53,000. Now let's just take one more example here. Let's say hypothetically, 1, 2, 3, 1, 2, 3. Let's say hypothetically I invested $1 million into, these ETFs. Now I personally would never do that. But, just for, the exercise here to compare the expense ratio with all the other metrics here the same. Let's say, for example, you just invested $1 million. You didn't invest anything more. You let it sit there for 30 years. The expense ratio difference, or the expenses that you're going to be paying over $600,000 more in, an ETF like QYLD versus, JEPQ as an example. Now let's just put that on an annual basis to make it a little bit easier to understand. Just annually, you're going to be paying about, $2,500 more each year. Okay. So that's another reason of why I decided to transition out of QYLD. Another reason why I decided to switch was the issuer. Now, this is not necessarily the biggest deal, but I think for me, it is one of those things where I'm just like, you know what? Would I sleep better at night having my hard-earned money in a fund from JP Morgan or from a privately held company in Global X? For me, it's a no-brainer. I'm going to go with JP Morgan. So that was maybe a little bit subjective for me. Maybe it's not the case for everybody, but that was just one of the reasons why. So now I want to transition to the main reason why I decided to make the change is what you're looking at here at your screen. So this is a chart of the last 90 years of the S&P 500. You can see the gray areas, those are recessions, but if you zoom out, right, the market continues to go up. And during my lifetime, if you were to ask me, Jake, do you think that the market is going to go up or going to go down over the next 30, 50, 100 years? Well, I think it's going to continue to go up, okay? And that has a fundamental impact on the return of a cover call ETF like one from QYLD and from JEPQ, okay? And I'll explain what I mean by that in terms of how the fund's methodology is set up. So if you go over to, QYLD's website here and you take a look at how their cover calls are set up, they sell at the money, so at the money cover calls on 100% of their assets. So 100% of the upside is forfeited. Okay, now let me say that one more time, just so that you make sure that you get it. QYLD, they sell 100% of the shares at the money cover calls. So you might be thinking to yourself, okay, well, what does that mean? What that means is the share price, unless they change the fund methodology, that means the share price will never go up. It will never go up to its all-time highs because they're selling at the money cover calls. So there's a difference between at the money, in the money, and out of the money cover calls. And for a lot of new investors who necessarily don't know what that is, it can be very confusing. So let me explain very simply what that is, and I'll show here in a chart here. So at the money is when the fund managers are selling at the money cover calls. It means if they sell it at the beginning of the month, there is no upside. There is only downside to the share price. Okay. Now you're getting that premium, the distribution, the dividend, if you want to call it such. You're getting that monthly, but at the expense of the share price, because the share price is capped. You will not see upward. You will not see the share price return to all-time highs. And what did I show you here earlier? The market will continue to go up. The market over time will continue to go up, but QYLD, because of how it's structured, unless they change this, the price of the index will continue to go down. Okay, that is at the money. Now, out of the money, that is something different. Okay, and just a brief overview of what out of the money means, because this is important because we'll talk about that with JEPQ. Out of the money means is if you buy a cover call ETF that is focused on out of the money, that means that there is potential for upside. So depending on what the market does, if the market goes up, you as an investor get to take advantage of that upside, okay? Because it's not capped, right? The difference is QYLD caps the upside. With JEPQ or JEPE, both of them, they don't cap the upside, and that's a fundamental difference. Now, if you look at this in a maybe of a different context or a different view here, let me zoom in and show you what this kind of means here. So they talk about different scenarios in a down market, a flat market, and an up market. So let's say, for example, you look at QYLD and you purchase it January 1st, and let's say the fund managers at Global X, they sell an at the money strike for 1 month out. Depending on, regardless of what the market does in terms of the upside, you are capped. You can only, you see this orange line, you're only going to get that upside potential. So if the market goes up, you forfeit all that. You forfeit it because you're realizing the premium distribution, the income, the dividend, right? And so the share price is affected by that. Okay. Now in a flat market, in an up market, it does hurt you the most. In a down market, what we're seeing in a down market, it hurts you maybe not as much, right? But in a flat market, it's kind of somewhat neutral, I guess. But in an up market, this is where you as an investor get screwed. Okay, you get screwed because you're capped at your upside potential, and you are not taking advantage of the market over the long term. You're sacrificing that upward potential for the current income today. And looking at this chart right here, if you're in your early 20s, 30s, and you have a long-term time horizon, you want this. You want to be a participant in the upward nature of the market. You want to be able to get on the bandwagon and enjoy the upward movement in the market. With QYLD, you're sacrificing all of that for a monthly dividend at a high expense. Okay. Now, if you go to the very, very bottom here, this is the thing that you want to make sure that you understand. QYLD writes cover call index options on the NASDAQ 100. By selling cover call options, the fund limits its opportunity to profit from an increase in the price of the underlying index above the exercise price, but continues to bear the risk of a decline in the index. Every person out there who's thinking about investing in these covered call ETFs, you have to understand the differences on how the funds are set up. And because of those reasons of why I told you earlier why I sold QYLD, this is the main reason why. Because I have a multi-decade time horizon, I want to participate in the growth of the market over time. Okay. And with QYLD, I'm not going to be able to participate. Okay. Now, this is even if you hold it in a Roth IRA in a tax sheltered account. It doesn't matter. It does matter, obviously, but the long-term compounding, you want to make sure that you understand how these funds are set up. Now let's go over and let's take a look at JEPQ, and let me walk you through what it is at a high level, some of the differences between, QYLD and JEPQ. So first off, the big difference that you have to understand, if you take away anything from this video when you're comparing the two, the one thing that you have to remember is you're going to get upside potential with JEPQ. Okay. Now with QYLD, you may get a higher higher dividend, a higher yield today, but your share price is going to be capped. So that's the fundamentally basic point that I want to make sure that everybody understands from this video. Obviously the expense ratio and everything else that I said, but the main difference is the upside potential. JEPQ, it's a cover call ETF. It's an actively managed ETF from JP Morgan. It's a little bit different because the fund managers here at JP Morgan, they have more flexibility with how they manage this ETF. So it's not a black and white approach where they just sell it against, sell cover calls against or write them against the index. They have a more active approach. Okay. And I personally like that because they can optimize based off of the, the environment that we're in, right? We talked about a down market, a flat market, and an up market. And so they have a little bit more flexibility depending on where we're at in the market. And they charge a reasonable fee of, 0.35, right? So it's not insanely high. So first off, it generates income through a combination of selling options and investing in U.S. large cap growth stocks, seeking to deliver a monthly income stream from associated option premiums and stock dividends. So the big difference here is, and I'll touch on this in a second, they don't write 100% of their covered calls against the securities. So with QYLD, they always write 100%. That's a big reason why the upside is capped. They write 80%. So they're not limiting the performance of 100% of the fund's equities, the securities, only 80% of it. Okay, so that's very, very important. You're going to get less volatility with a covered call ETF like this. Once again, the upside is going to be capped as well, but not as much as QYLD. So a couple of things. First off, they talk about, the fund managers, history and their experience, yada, yada, yada. I don't really care about that. Okay, that's cool. All right. I invest into this assuming that you guys you got your stuff together, right? This is the most important thing for me is the options overlay. So they write 1 month out of the money call options designed to generate income and give investors a portion of the upside with reduced volatility. That is the main thing here. The big difference is out of the money call options versus at the money call options. Okay, very, very important. So what is the role of JEPQ in your portfolio? It's an income-focused portfolio, investment, right? So if you have a 30-year time horizon, even if you're reinvesting the dividends, even if it's in a tax sheltered account like a Roth IRA, JEPQ is not going to be for you. If you have a time horizon less than 5 years, this is the type of investment for your portfolio. But even then, in my opinion, you wouldn't want to necessarily way overweight into an ETF like this. And I'll talk about that here towards the end of the video. All right, so if you go under their prospectus and you take a look at, what they say for, this cover call ETF, they talk about the expenses, they talk about, the portfolio turnover, but the most important thing that I want you to take a look at is this piece right here. This is the investment strategy of how it's set up. And this is what you need to understand if you're going to invest into a cover call ETF, is understanding this piece and how it relates or compares to other options, like, for example, a QYLD. So the first part is, it talks about it's an actively managed approach. They also, create income through, or the distributions through equity linked notes. These are derivatives. Derivatives are, futures or options. It's the options market of the underlying index, or in this case, the NASDAQ, but it's not the entire NASDAQ. It's actively managed. It's a portion of the index. So it's not just like, okay, they take all the NASDAQ 100 and they write a straightforward call option against them. They have a lot more flexibility. So I'm sure a lot of you are going to be confused, and I may have not explained that the best, but the important thing that you need to understand is it's not a black and white approach like QYLD. There's a lot more that goes into it. And these equity linked notes can be a little bit confusing, but at its core, they're derivatives. They're the call option, I guess you could say. And it's kind of similar to what you would get with QYLD. It's the options premium. Okay. But the thing that I want to highlight here is under normal circumstances, once again, this is actively managed, the fund invests at least 80% of its assets in equity securities. So this is the difference with QYLD. With QYLD, they do 100% and they do it at the money, right? So in calculating the 80% policy, the fund's equity investments will include common stock. So, that's just normal shares like any other ETF, and equity linked notes, as well as other equity securities. So that's the big thing that you have to understand when it comes to this ETF and how it compares to other cover call ETFs or ETF strategies out there. So I personally like it because it doesn't cap the upside. Now let me show an example here really quick. This is with JEPI. This is with the S&P 500 cover call ETF from JP Morgan. But let me show you what this would reasonably or could potentially look like with a cover call ETF like JEPQ. Is when you get your dividend, a percentage of that dividend is going to be considered qualified. The other percentage is going to be considered non-qualified. Non-qualified is like your W-2 income. It's like your day job. It's not tax efficient. Qualified dividend is treated much more favorably here, in the United States. You are taxed at a much lower rate than with, for example, your ordinary income. And so what you can see here is in blue, you're going to see the distribution or the difference between what are dividends and what are the premiums. So the premiums, that's the cover call premium that you're getting from the fund managers writing call options out of the money, right? Against the shares that are held in the index that they have here. So a percentage is going to be qualified, the other percentage is going to be non-qualified, but as you can see, the overwhelming majority is non-qualified, so this is not necessarily the most tax efficient. It's not like purchasing Coca-Cola, where Coca-Cola would be 100% blue and zero, orange here, okay? That's the big difference. Now, another example would be, for example, if you were to buy a real estate investment trust, the majority, in most cases, it would be 100% orange and zero blue. Okay. So it's just understanding how the dividends or the premiums are taxed. All right. Now let's take a look and let's see how JEPQ is compared to QYLD. Now, bear in mind, this is, take this with a massive grain of salt. Like there's not a lot of historical data here to backtest, but let's just take a look and see, here in Seeking Alpha, how these two have compared. So since the inception of JEPQ, you can see here, middle of this year, the price action has been fairly similar, though it's been better in favor of, JEPQ. If you look at the total return, it's also been slightly in favor of JEPQ. So I don't want you to read too much into this. I think this is something that you would want to track over time. But if you did want to see more of a, a little bit of a bigger picture, now this, once again, this is not a real representation of what this would look like over a longer period of time. But if you were just to compare this with JEPI and XYLD, this is the version from Global X. This is focused on the S&P 500. JEPI is focused on the S&P 500. JEPQ is focused on the NASDAQ. You can see that the price return over an extended or a longer period of time, you can see that JEPI has outperformed the XYLD. And if you look at it from a total return point of view, you can see that JEPI from a total return point of view has actually outperformed XYLD. Now, the way that you do this, you just do it in the, you just add the comparisons here. You could add, what would it look like compared to the S&P 500? And you can see, the total returns, what it would have looked like, compared to different investments. Now, this is something that you're only going to be able to do with a premium. For those of you that follow the channel, you know that I love Seeking Alpha. I'm a huge advocate of them. They actually sponsor the channel. If you want to sign up to Seeking Alpha Premium, you'll actually be able to sign up for $99 instead of $239. You get 58% off using my link. I'll leave a link in the description below. But yeah, I do obviously benefit from it. And so yeah, if you want to use my link, really appreciate it. All right, so now let's take a look at who should not consider investing into a covered call ETF like JEPQ or JEPI, for example. So first off, if you have over 5 years, these are most likely not the investments for you. These ETFs, regardless of where they're held, in a tax sheltered account, even if you're reinvesting the dividends and not paying any taxes on the dividends, due to the compounding rate of these ETFs compared to the underlying index, for example, the NASDAQ or the S&P 500, in most cases, you would be better off holding the actual index instead of a covered call ETF like this. So that's very important to understand. These are income ETFs, and you really have to understand your time horizon. The second thing is if you're in a high tax bracket, if you have millions upon millions of dollars and you have that in a taxable account and you're looking to retire early off of these ETFs, bear in mind the tax burden that you're going to be facing with holding ETFs like this. Okay, so very important. If you're in a high tax bracket, probably not the right choice for you. The third reason is if you want your portfolio to continue to grow, you want to 10x your returns, and you want to sell off the shares in the future. This is an income ETF. It's not something that you're going to buy low and sell high when it comes to the actual shares in the portfolio. So you really need to make sure that you have your expectations in line of what you're actually getting with an ETF like this. The last reason why you would not want to consider, an ETF like this is if you're really an experienced investor who could, sell your own covered calls or write your own covered calls in your brokerage, right? You can write covered calls against your own shares in your portfolio. You wouldn't necessarily have to have an ETF like this do it for you. Obviously that's going to be a lot more time consuming, and, there's other factors that go into that. But I guess, if you are an experienced investor and you want to do this yourself, you could do that instead of holding a covered call ETF like JEPQ or JEPI, for example. Well, everybody, that is why I decided to transition from QYLD to JEPQ. Now, this is not me promoting one ETF or the other for everyone. I'm not trying to, say that this is the right approach for everyone watching this video. Everybody's got to, do what's right for their own particular situation. Really, the goal of this video was to share with you why I made the decision for me. And for some of you, some of the things that I highlighted are not going to be relevant for you. And that's completely fine. The last thing that you want to do is go and listen to some stranger on the internet and make all of your life investing decisions based off of, a single video, right? So I hope that this video kind of opened your eyes to understanding the differences between these covered call ETFs and if they're even the right choice or option for you to begin with. Hope that was helpful. Thanks for watching, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.